So when you own the home, you're paying the lender every month for a fixed period of time with your home as a collateral. So the collateral is what the lender is putting a lien on. Because so on the off chance that you don't make payments, that's what they're going to use as collateral and possibly collect on that. What type of mortgages are there? So one of the most important things that a loan officer will do is, I mentioned this earlier, is try to tell you and let you know what kind of programs are going to be best for you, for your specific situation. There are several factors that go into that decision, and there are also several loan programs that are out there, some of which people don't even know that they are either eligible for or they even exist. So the most common mortgage program that you're going to see out there is a conventional loan. It makes up over 40% of all loans. That is the most common loan type. The second most common loan type is an FHA, which is really popular with first-time home buyers or someone that may have like a little lesser credit score. That's a really popular program. And then VA, those are for folks that have served or are currently serving in our military. That makes up 20% of the product mix when it comes to mortgages nationwide. Really cool product because you don't have to put any money down a lot of times, and there's no PMI. Lastly, we've got USDA, which is more for rural properties, and that is also a 100% financing option. And lastly, we've got investor programs. So these are kind of like your outside of the box loan types. Not as common for folks that are buying homes, but they are out there for some special scenarios. So how do you actually get a mortgage? The lender is going to look at three different things: and credit, income, assets. So think of it as like CIA, and think of it as like we're going to investigate, for lack of a better term. We're going to look at your credit, your income, assets. So not only credit history, but like what's your credit score? Do you have the income to pay back the loan? And do you have enough money for if you have to have a down payment or closing costs? Do you have enough money to your name to do so? As far as credit score, so right now most lenders use what's called a FICO score, and those scores can range from 300 all the way up to 850. The average score in America is somewhere a little over 700 right now. For the most part, if you are above like 740, you're getting some of the best pricing out there and some of the best rates out there. That's kind of the top end. And if you are above a 620, you're going to have a lot of doors open for you in regards to loan programs and different lenders. 620 is a very important level right there for a bunch of different lenders. There are some programs that you can go below 620. We'll get to that here in a minute. But know that those are pretty much your two most important like little thresholds. You got the 620, that's a big benchmark. And then if you want a really, really good rate, that 740 is a really big benchmark. Let's talk a little bit about credit history, because that is one of those things where, you know, if you're short on funds, we can find ways to alleviate that, whether it be through down payment assistance programs or a possible gift. But it's really hard. Like if you go in to go buy a house and you don't have the greatest credit, that's one of the things that's really hard to fix in a very short amount of time. So a lot of times you want to focus on your credit, even if it's years in advance. And there's a lot of misconceptions and a lot of misinformation out there about credit. So let's break down a couple of things that are good and bad events on your credit. So let's just say that this is a 10-year credit history profile. Let's say a lot of people, the first debt that they take out is student loans. So that starts their credit history. Next, we have a credit card. A lot of people, like, that's kind of their second step. It's either a credit card or like a car loan, something like that. Anytime you open up new accounts, it will temporarily drop your score, but then it'll start working back up as you make some payments. So it's all about history. What you have to show the creditors is that you are good at paying back money. That's how you increase your credit score. Now, credit limit increased, that can help your credit score. So when you increase your credit, let's say that you've got a $1,000 credit card and you have a balance on it of $300, but then your credit card company comes back and says, hey, we're going to actually we're going to increase your credit limit up to $2,000. But then you keep the same low credit card balance, even though your limit went higher. That shows the creditor that you are financially stable and you have access to credit but you don't need and you aren't utilizing it, which shows a lot of financial that you're financially savvy. It shows a little bit of stability. So if you're going to use revolving accounts, like a credit card or any kind of other line of credit, really try to keep a balance low, but keep it active. That tells the creditors that you are actively using credit, but you don't necessarily have to because you're not borrowing a lot against what's available to you. You going and maxing out your credit card is one of the worst things that you can do because it shows that you have to borrow money. So it's kind of almost a psychological game. Like you want to show that you have the ability to borrow money, but you don't necessarily have to borrow money. Let's keep going. Let's say that you then close that line of credit. One of the things that people don't realize is when you go and close an account, a credit account, temporarily, your credit score is going to go down because it's an account in its history that is now no longer reporting. So it's data that you can no longer use as far as like what is going forward. Basically, how you performed on that line of credit is now in the past. Same thing, one of the most detrimental things that you can do is have a late credit payment. That can take forever in an act of Congress to get off of your credit report. And that can be one of the things that's the most detrimental. If you, let's say you charged up your credit card, you can then go pay it down and increase your credit score. But if you have like a 30 or 60-day late on there, it's hard to erase that. There's really no going back unless you get the creditor to agree to forgive that. Let's say we did a car loan. We paid off the car loan. We went over that a little bit. That is another situation where, yes, it's great that you paid off your car. Fantastic. It's going to drop your score just a little bit temporarily and it's going to build back up. But a lot of people start to freak out when they're like, hey, this should be awesome because I paid off my credit card. I'm debt free when it comes to that car. But keep in mind, you are losing an account that is reporting. So you are losing data that is reporting to your credit report. One thing that a lot of people are cognizant is how often they're getting their credit pulled. So there are two different types of credit inquiries. One is called a hard inquiry, and that is when a lender pulls your credit and it's going to affect your score, usually anywhere between 2 to 5 points. Now, there's also what's called a soft pull, which is something that you can actually do. You can go to, say, free credit score, freeannualreport.com. You can go check your credit for free, and it's not going to affect your credit score because you are pulling it. If a lender pulls it, if it's a hard credit, it's going to affect your credit score a few points. If you pull it yourself, it's not going to affect your score. Same thing, student loans paid off, fantastic. That's great financially, but from a credit standpoint, I expect a little bit of a dip. But this is why, you know, it's important to pay off your student loans. It's important to pay off your cars, but this is why it's important to have several different lines of credit and several different credit profiles so that you, once you pay something off, you're not as hardly, you know, you're not as punished as much. So I personally have 3 credit cards. So if I were to go borrow money for a car and then go pay that off, I've still got enough data reporting to the credit bureaus because I have 3 other credit cards. It's not as detrimental to me as it would be for someone who, let's say, only has a car loan in their name and that's their only credit, the only thing that's reporting on their credit profile. If they go and they pay off their car loan and they don't have any kind of like credit card or any other active credit after that car loan's paid off, it's a little harder for them. It's a little bit harder on their credit score because they don't have anything else that's active. You want to constantly have access to credit, but not necessarily use it. Credit score requirements, conventional, you need at least a 620. FHA, a lot of lenders need you to have at least a 620. You can actually go below a 580. VA, there's technically no minimum credit score with VA. If you get below a certain threshold with a lot of lenders, you're going to have to do what's called a manual underwrite, which is going to require a little bit higher of an interest rate and a little bit more paperwork. Same thing with FHA, they do have a manual underwrite process as well. Just know that if you have to do a manual underwrite, then you are going to have a little bit higher of a rate typically, and it's a little bit more paperwork, but it can still get you into the house. USDA needs a 640. That is the one that's 100% financing that if you're buying in a rural area. It's a little bit more strict when it comes to credit. So why is all of this important? Why is homeownership important? One of the biggest reasons is because it has the ability to build generational wealth. So let's take a look at this slide, and let's say that the average house in America cost in just over $30,000 in 1940. Now you take that same house and you fast forward to 1980, and we're talking about $93,000. So theoretically, in those 40 years, you've gained about what, $60,000 worth of equity. Now fast forward even more. Let's say you bought a house in 1980 for $93,000. That same house statistically is worth over $400,000 in 2021. As you can see, like, you have to live somewhere, but because you are buying instead of renting, it is going to not only start paying down your balance and you are building equity, but the value of the house over a long period of time, when you start to zoom out, the value goes up. There's never been a if you zoom out and you look at just like little 10 and 12-year increments, there's never been a 10 or 12-year increment where the value of a house has been lower at the end than it was at the beginning. So what a lot of people, they get caught up on is like, what is the value of my house going to be next year? And what I think of it as is like, I'm 35 years old and I've got a 401k. I don't necessarily watch my 401k value because I am probably 20, 30 years from retiring. That does not affect my finances that much right now. The same can be said for my home value. Right now, it's not important to me because the need that it fills right now is like, it's got the location that I need, and it houses my family, and it is in my budget, my monthly budget. The value of it is just kind of bonus points at this point. There are different strategies you can have when the value does increase, and you can leverage that property and then possibly either pay off high interest debt or go buy more property or do other wealth building activities. But overall, if you have to live somewhere, if you're renting, you are paying somebody else's mortgage. You are paying your landlord's mortgage, as opposed to if you are paying yourself, essentially. It is a slower game most of the time, but the value over a long period of time tends to increase. This is per the Federal Reserve. This is a study that they conducted, and homeowners have a 40 times greater net worth than renters. And that, as you can see with this chart, I mean, with the home, if you look at the colored little rainbowish, purplish blocks, $120,000 for the average homeowner is about how much they have in equity in their house. That's what is attributing to their net worth. Now, one of the ways that you can also build wealth with owning a house is you have that fixed payment. Whereas rent tends to kind of go up with time, that fixed payment is really, really important because you're basically freezing that moment of time, and you are able to save money based on that. As inflation increases and the cost of other stuff increases, your housing payment is staying the same, allowing you to save money. So right now, the house that I bought in 2017, 2018, something like that, and it has a really low interest rate right now, that has now turned into a major wealth building opportunity for me in this market and in this economy because of the inflation, because I know that my payment is fixed. And even if you buy right now, it's going to be the same. The same holds true 10 years from now. You're going to be sitting there thinking, my goodness, I'm so glad that I locked in that predictable monthly payment so that I can start building wealth, and I can start adjusting my finances around some of these fixed payments that I have. So what can you do today? Even if you are not ready to buy right now, you can still take actions. There's a couple things that I recommend. So even if you're about a year out from wanting to buy a house, I always recommend that you go and you talk to a mortgage loan officer. Go ahead and pick their brain, make a plan for the next year, so that if they pull your credit, or they look at your debt to income ratio, or they look at how much money you have in the bank, you still have time to make a plan and deploy that plan so that you can buy a house a year later. The worst thing you can do is, I've got 2 months left on my lease. I'll just go ahead and go get pre-approved now. And then all of a sudden you realize, well, I'm not ready to buy a house now. I can't get pre-approved for a house. And now you're having to go back and stress out about that rental. So if you know that this is like a goal of yours, go ahead and set up an appointment with a mortgage loan officer. Make a plan for the future. They can give you some tips on how to get there and basically how you need to structure your life and structure your finances so that when you are ready, you will be able to buy. Some things that you can do is develop and practice healthy habits and save money. One of the tricks that I use to save money is I automate my savings. So just like I automate paying my bills so that I know that they get paid on time, I automate my savings. When my paycheck hits my account, I automatically have a certain amount of money go to savings account. That's helped me, and it's not something that I manually do unless I do have an excess of money in my checking account that I don't need. But automating that it puts it on auto mode. It puts it on autopilot so that you're not having to think about saving money. So what I do at the very beginning of every single year is, all right, what do I want to save this year? And then I break down the math and reverse engineer it. And okay, how much does that mean per paycheck that I need to save? And this could be like not necessarily even buying a house. This could be like for a vacation or for a college fund or anything. But start doing that and automate your savings, and that will help you save without even like realizing it. 6 months from now, you'll look at it and like, oh wow, that account's grown. Another thing that's very, very important because credit score plays such a huge factor is to pay your bills on time and keep your debt as low as possible. Above all else, you want to really make sure that you are not missing any payments because not only is that detrimental to your credit score, it could be detrimental to a mortgage approval as well. So try your best to pay all of your bills on time. Open a credit card if you've not done so. Credit cards get a bad rap in a lot of personal finance circles. But if you know how to use a credit card properly, it can be a really good tool to increase your credit score. So the key with your credit card is to keep your balance low. Now, if you go over 30% of what your limit is, so like let's go back to that $1,000 credit card we have. If you let your balance go over $300, it'll start to hurt your credit score. But if you keep it under, say, $100, under 10% what's called credit utilization, your credit score will start going up pretty quickly. And then there's this old adage, this old saying of if you can't manage $100, you will not be able to manage $1,000. So building wealth and saving money is all about scaling. So this general theory of if you can't manage $100, then you can't manage $100,000. You have to start developing these habits, not only like spending habits, but saving habits. Doesn't matter how much money you have to your name right now. Go ahead and get that started. All right, how to hit your home buying goals. So first and foremost, save for down payment and or closing cost. Try to have some kind of savings that you've got saved up. And again, let's go back to automating that process. If you don't have much money saved up right now and you want to buy a house, let's say a year from now, figure out, okay, well, I need $10,000 to buy say a $200,000 house, $250,000 house in my area. If you've had a conversation with a loan officer and you've broken down those numbers, now you know what your goal is. So then you can reverse engineer it and start saving for that down payment and closing costs, and you know how much you need to save throughout the year. Number two, work on your credit score. So your credit score not only will affect your mortgage pre-approval and your approval amount, but it will affect the interest rate that you get. So, and the better your interest rate, the more home you can buy because the payment's going to be lower. Not only that, but it can possibly help you get into a more affordable house because the interest rate is lower. Third, we talked about this earlier, but go ahead and get pre-approved or go ahead and talk to a loan officer, no matter where you are in the stage. If you are 1 year out, 6 months out, but if you are inside 6 months, it is really important that you start to talk to a loan officer immediately so that you know how much you can buy, how much you can borrow, and you can make a plan for the future. A couple of folks that you can follow, shameless plug, myself. These are people that put out a lot of useful content that it's not real salesy. That's kind of what we pride ourselves on. It's a lot of educational content, and we teach a lot of different fundamentals and concepts for home buying and mortgages. Myself, and then Rebecca Richardson. If you don't know her, she is the mortgage mentor on TikTok and Instagram and YouTube. Ariel is she's basically the VA. She's branded herself as the VA loan lady, and she knows so much about VA loans. I learned something from her every single day, and I thought I knew a lot about VA loans. If you are possibly VA eligible, I cannot recommend following her enough. You will learn so much and get so much out of that follow. Um, Alyssa, she is a loan officer as well, but she has a business called Color My Credit, and it's less about it's not about credit repair. What she dubs it as is like credit, what does she call it? Credit enlightenment or something like that. So it's not about repairing your credit, it's about understanding how credit works. That's what she really focuses on, because a lot of times these credit repair companies, it's a band-aid fix, whereas you being empowered and knowing how credit works, that is a lifelong skill set that can affect your finances for the rest of your life. So that's what she calls it. She calls credit empowerment. It's not credit repair, it's credit empowerment. She gives you so much information so that you can learn everything that you need to know about credit. Me, even being a loan officer, I've learned stuff from her in the past. She's one of my favorite follows on social media. Gina, she goes by Saving Wiz Gina, and she's on Instagram, TikTok, recently blew up on YouTube. She gives a lot of really practical ways to save money in just everyday life, and that whether that be on groceries or that's really what she focuses on, is on like food and groceries. But there are other savings tips that she gives out, but cannot recommend her enough. It gets you in the saving mindset, which is half the battle sometimes when you're trying to save anyways. That one went pretty quick. So let me know if you have any questions. I know that was a very high level look. If you do have more very personal and individual questions, feel free to reach out. Let me know. You can book a call with me or any folks that are on my team. We are here to help. We are here to educate. That's what we really strive to be. We're here for a resource. And that's about it, guys. Hopefully this helped. Again, if y'all need anything, feel free to reach out. There's a bunch of resources that we are putting out there all the time that help you learn not only the power of home ownership, but how to actually get that done.